What's going on, everyone? It's Griffin here, and in today's video we're going to be covering a handful of stocks that you should at the very least add to your watch list in the month of July and moving into August, now that we're mid-July at this point. And these are actually stocks that I have spoken about in the past on the channel and that I happen to hold in my own portfolio, so I always love giving the audience updates on these companies. Let's just get right into it. The first stock we'll be speaking about is Corsair Gaming, ticker symbol CRSR, and this is actually a company that I happen to have spoken about only a couple of weeks back when Wall Street Bets picked up the stock and basically shot up its value by around 50% in the matter of one single trading day. In that video, I shared two theories on what I believed would happen with CRSR stock as a result of Wall Street Bets picking it up. And yeah, naturally, the most logical one did end up materializing, where after that initial run up, it quickly sold off back to pre-run up levels, now down roughly 40% since its peak in November of 2020. This, however, does not change anything on my overall thesis around this stock, because the whole Wall Street Bets ordeal really was just a pass-through, and from a fundamental level, Corsair stock is still really undervalued in my opinion in the larger picture, and I think that it still has a lot of growth opportunity ahead of it. And just because Corsair quickly became a meme stock temporarily there, this doesn't change anything about this company's past growth as well as future growth expectations, all of which give me confidence that this is a stock that is going to be able to comfortably bounce back out of its stagnant trading over the past couple of months. With that said, right now we are looking at a stock that's trading for under $30 per share, which we haven't seen it in a while, and this makes it nearly flat since March of this year. And overall sentiment towards the stock just seems to be extremely low, even though Corsair has been posting fantastic growth figures lately. And in reality, Corsair actually happens to be one of the worst performing stocks in my overall portfolio as of right now, having recently even turned into the negative. So of course it's not fun to hold a stock that is not performing up to par with your expectations for it. However, let's remember here that generally speaking, and if we look at this from a historical standpoint, stock prices will tend to follow the growth of a company's underlying financials and fundamentals. So this is something that you can actually attribute to pretty much most companies if you actually look at their stock growth in relation to the growth of their underlying financials. Whenever this ends up differing too much, typically it's going to come back to a level that is in line with the underlying financial growth. So Corsair is a company that has been laying down the financial foundation for further growth over the coming years. We can see here that over the course of the past 4 quarters, CRSR has been steadily increasing their top line, with the exception of Q1 2021, as Corsair's sales do seem to follow a more seasonal pattern. But this is also to be expected, as Q4 is always going to be the best quarter for this type of company that sells products that are popular with kids and teenagers. Q4 is always going to be the best quarter, with higher levels of consumer spending as a result of Black Friday, Cyber Monday, and the holiday season. In fact, Q1 of this year posted revenues roughly 72% higher than in Q1 of 2020, and I expect that over the rest of the year, Corsair should be in a position to post revenues in excess of 2.3 billion, with net income in the waters of around 250 million. And right now, the company's forward PE is listed at only 15x, and considering the trailing 12-month PE of 19.6x, this means that in reality, the stock is trading for quite a bit lower than the peers in its industry on multiple ratios, including the price to earnings, price to sale, price to book, and even price to cash flow ratios. Pretty much exactly what you would want to see from a company that isn't yet valued up to par with the rest of its industry. Another metric I like to look at in a growth stock like this one is the company's operating margin, because this gives me a bit more insight on how well the company is scaling their operations relative to the costs associated with this growth before taking into account other expenses like interest payments and taxes. And as we can see, Corsair has been doing a great job of increasing their operating income, and with an operating margin over the past 12 months of 11%, this is a significant increase, first of all, over 2019 levels, and it blows industry peers out of the water. One of the more comparable companies to Corsair would be Logitech, and placing their financial ratios head to head, we can see that Corsair shows much nicer value than its competitor. The last thing I want to quickly cover for Corsair stock is the company's level of debt. The company is looking currently at roughly $294 million in debt, which they have actually managed to pay off substantially over the past year, and it has now stated that they're aiming to further repay company debt by another $72 million over the course of 2021, which of course will both reduce interest payments and subsequently allow for higher levels of cash flow moving forward. So all of this to say that it is never fun to hold on to a stock that is seemingly just weighing down your portfolio. But as Warren Buffett would say, if a stock that you truly believe in for a logical and fundamental reason is losing market value, then it makes absolutely no sense to cut your ties with that company simply based on price action alone. Rather, you should be doing more research into trying to determine whether or not anything has fundamentally changed in this company and its operations. If not, then you should be either bolstering your position or just holding on for when inevitably the market will start recognizing the value of this company. Over the past 2 years, investors seem to have become accustomed to investing in a stock with a 3 to 6 month time horizon, expecting 50% gains over that period of time, but that's simply not the long-term reality of the stock market. So if you've been holding on to this stock for the past several months, then I am right there with you. It's definitely not fun to hold on to a stock that is trending sideways for an extended period of time. However, I have a strong feeling that as the company starts posting Q2, Q3, and Q4 figures for 2021, we'll see somewhat of a turnaround for the stock, and hopefully it will start approaching those analyst price targets, which would only make logical sense. But once again, this is pretty much just my own opinion here. Make sure to do your own research, and none of this is financial advice. If we don't, well, we're going to be seeing a company that's trading for like a 5x PE, which would be great for me because I'm going to continue bolstering my position. With that said, make sure to let me know down in the comments what you think of Corsair stock, if you think it's going to continue trending downwards or we'll see some type of reversal. I'd love to know. Let me know down in the comments. Hey, by the way, if you're enjoying today's video, all I'd ask in return is that you give it a thumbs up. And also, if you need to still open up a brokerage account, make sure to check out the links down in the description. You can open up either a Questrade account and get $50 for free in trades, or Wealthsimple Trade, where you'll get $25 for free simply for signing up and investing $100. So make sure to check out those links down below. All right, moving on to the second relatively cheap stock that you should at the very least be adding to your watch list this month. We have a company that has just been slapped over the past 6 months or so. It is Alibaba stock, ticker BABA, which remains significantly down from its peak price of $319 per share in October 2020, now down roughly 35%, and this stock just doesn't seem to be able to catch a break. Now let's just address the elephant in the room right away, being the fact that Alibaba is a Chinese company, and every single time I mention a Chinese company on the channel, I get a fair share of viewers commenting down below that they simply might not be comfortable investing in a Chinese stock, which is definitely fair. At the end of the day, it's your money that you're looking to invest in the stock market. So if you're not comfortable investing in a given company as a result of any reason, geographical region being one of them, then you quite simply just should not invest in that company. End of story, regardless of how attractive it might seem from a valuation or fundamental level. And while there are different schools of thought as to whether or not investing in a Chinese company poses additional risk, well, there are some concerns that you should be aware of that you would never have control over when investing in a Chinese stock. For example, tighter regulations on companies that pose a monopoly risk, as well as new Chinese IPOs like we've recently just saw with Didi, as well as massive fines like we did recently also see for Alibaba. And some people are even wary of certain accounting practices coming out of these firms. So yeah, all of these are definitely fair, and as part of your broader research in a company, these types of qualitative elements are definitely things that you should take into consideration in your research and thesis on a stock. But it's risks such as these ones, along with potential future legal obligations, that seem to have some investors spooked or weary about investing in Alibaba stock, which ultimately is what's leading to the price being driven down for Baba stock. The way I see this though is that that if China does become a bit more strict in the way that their own companies can list on American exchanges, this is most likely going to actually be a beneficial factor because tighter regulations will make things a bit more compliant. And then also, it's really in this country's best interest to allow foreign funds to be flowing back into their companies to further boost the Chinese economy. Regardless, this is a type of company that lower stock price is only making it more and more attractive from a fundamental level, and that's not even taking into account the expected growth rate of the Chinese e-commerce market over the next decade. The Chinese and Indian markets are expected to boast the largest GDP gains over the next decade and have a massive increase in their middle class, which is propelling both their tech and consumer discretionary industries, all of which will be beneficial for a company like Alibaba. Taking a look at Alibaba's financial growth over the past couple of years, we're seeing a firm that's been continuously picking up momentum with year-over-year top-line growth from 2020 to 2021 of 40.7% and average annual earnings growth over the past 5 years of 29.8%. And in complement to this, moving forward, the company is expected to continue growing at around 17% per year in top line and around 10.5% per year in earnings growth. So although estimated future growth isn't expected to be as explosive as it has been in the past, well, Alibaba is still a company that is expected to continue growing at a very nice pace, and then combined with this lower price point as a result of low market sentiment towards the company, this is a recipe for a nice turnaround over the coming years. As we speak, Alibaba's trailing 12-month PE is sitting at 25x with a forward PE of 17.76x, and this is among the lowest earnings valuations the company has seen in the past 5 years. What's more is their current price to sales ratio is roughly 5.5x, which is right around the lowest this stock has seen in the past 10 years. So although Alibaba is a company that may potentially pose some additional risks considering the fact that it is a Chinese company that some may not be comfortable with, well, we still cannot ignore the really attractive current valuation for this stock. And as Peter Lynch would say, stock prices tend to follow earnings and financial performance over an extended period of time. And then finally, as somewhat of a bonus stock for today's video, I really wanted to give a quick update on GoEasy, ticker symbol GSY on the Toronto Stock Exchange, which has had a fantastic run since I first got in and spoke about this stock at around the $80 per share range. And even though the stock price has since more than doubled, the stock's PE hasn't actually budged all that much, and I believe that it's still a fantastic stock to own in a growth-oriented portfolio that still also throws off a small but still nice and complementary dividend. This is a company that's top line operating income and bottom line figures are seeing nothing but linear growth. And as a shareholder, I just couldn't be happier right now with how this company is being operated. GoEasy is just a cash cow. I mean, take a look at this profit margin of 46.72% and operating margin over the past 12 months of 37.44%. This is a cash cow of a company, and the PE is still sitting at around 11x right now, which is lower than most large banks even. With that said though, considering the fact that this stock is trading basically at all-time highs or right around that level, we definitely cannot consider this to be a bargain of a stock, but the value is still there based on the growth of their earnings as well as their top line. So this is a company that I do still potentially see some nice upside over the coming years. I'm still holding on to my shares of GoEasy. So that's my quick update on GoEasy, and I really hope you enjoyed today's video going over those two other stocks being Corsair and Alibaba, both of which right now, based on their current market price and the value ratios of these companies, I see showing some really nice value and upside over the coming years. Always remember, right, that just because a stock isn't necessarily doing well from a market price standpoint does not mean that this is not a company that is growing on an internal and underlying standpoint. So over time, the stock market is really like an auction house, and sometimes some companies are not going to go and command the type of value that they deserve, and these are two companies that I believe once there is a turnaround and shift in market sentiment towards these companies, we're going to inevitably see their market prices reflect the growth of their financials. I'd love to know your thoughts though on both, or actually all three of these companies. So make sure to let me know down below. If you enjoyed the video, all I really ask in return is that you give it a thumbs up. And I'd also really encourage you to check out the resources I use and recommend down in the description box. We have stock brokerages, we have investment accounts, free Bitcoin if you sign up with BlockFi, and a bunch of other resources. So with that said, thanks a lot for watching today's video, and I will see you in the next one.